Imagine waking up every morning knowing that your money is quietly working for you, paying you cash just for owning the right assets. That's the magic of dividend investing. But when it comes to building a dividend portfolio, there's one question every investor faces: should you invest in dividend ETFs or individual dividend stocks? Today, we're going to break this down so you can make the best decision for your financial future. Welcome back to Stock Predictor, your go-to place for smart investing and wealth building ideas. Let's start by understanding what dividend investing really means. Dividend investing is a strategy where you buy stocks or funds that pay regular cash payouts, known as dividends. These dividends come from a company's profits, meaning as the company grows and earns more, so can your income. Some investors reinvest these dividends to buy more shares, compounding their growth over time. Others use the payouts as steady passive income, especially in retirement. Now, there are two main paths to dividend investing: buying individual dividend stocks, or buying dividend-focused ETFs, exchange-traded funds that hold multiple dividend-paying companies in one basket. Both can give you that sweet stream of income, but they come with very different pros and cons. Let's talk about individual dividend stocks first. When you invest in individual companies like Johnson & Johnson, Coca-Cola, or Procter & Gamble, you're hand-picking businesses with a strong history of paying and growing their dividends year after year. These are often known as dividend aristocrats, companies that have increased their dividend payments for at least 25 consecutive years. The biggest advantage of owning individual dividend stocks is control. You get to choose exactly which companies you invest in, how much of each you want to own, and what kind of dividend yield you're aiming for. You can study a company's financials, look at payout ratios, check dividend growth history, and decide if you trust the business model long-term. You're the one in charge. Another major perk is the potential for higher returns. Some individual dividend stocks not only pay consistent income but also offer strong price appreciation. Think of Apple or Microsoft, companies that not only pay dividends but also have huge capital gains potential. If you pick the right companies, your total return can far outperform a dividend ETF. There's also a tax advantage in some cases. When you directly hold stocks in a taxable account, you might qualify for lower tax rates on qualified dividends, depending on how long you've held the shares and your income level. Plus, you can decide when to sell shares, giving you more control over your capital gains taxes. But individual dividend stocks aren't all sunshine and rainbows. There's risk, and a lot of homework. You need to research each company carefully. You must understand its balance sheet, cash flow, and dividend sustainability. If one of your chosen companies cuts its dividend, your income stream could take a hit. And let's be real, not everyone has the time or expertise to analyze 10 or 20 different companies. Building a diversified portfolio of individual dividend stocks can take years of effort and thousands of dollars to start. If you only have a few thousand to invest, it's hard to spread that across enough companies to reduce risk. That's where dividend ETFs come in. ETFs, or exchange-traded funds, are like ready-made baskets of dividend-paying stocks. Instead of picking each company yourself, you can buy one ETF that holds hundreds of them. For example, the Vanguard High Dividend Yield ETF VYM, Schwab US. Dividend Equity ETF SCHD, and iShares Select Dividend ETF DVY are some of the most popular options. For dividend investors, the biggest advantage of dividend ETFs is diversification. When you buy one dividend ETF, you're automatically spreading your money across dozens or even hundreds of companies. If one company reduces or eliminates its dividend, it won't hurt you nearly as much because the others will help balance it out. Dividend ETFs also make investing much easier and less stressful. You don't have to analyze financial statements, watch earnings reports, or worry about picking the right stock. You just buy shares of the ETF and instantly own a piece of many strong dividend companies. It's simple, hands-off, and perfect for people who want passive income without constant management. Another plus is liquidity and low cost. ETFs trade just like stocks, so you can buy and sell them anytime during the trading day. Many dividend ETFs have very low expense ratios, often less than 0.10% annually, which means you keep more of your returns. However, ETFs come with downsides too. The main one is lack of control. When you buy an ETF, you don't get to choose which companies are inside it. That's decided by the fund's manager or tracking index. If the ETF adds or removes companies, you have no say in it. You might also end up owning companies you wouldn't personally choose to invest in. Another drawback is the dividend yield itself. Because ETFs spread their investments across many companies, their average dividend yield is usually lower than what you might earn from carefully chosen individual stocks. Plus, ETFs charge a small management fee, which can slightly reduce your overall returns over time. And let's not forget taxes. When you hold dividend ETFs, you might get capital gains distributions you didn't plan for, because the fund manager buys and sells stocks within the ETF. Those gains are passed on to investors, meaning you could owe taxes even if you didn't personally sell anything. So how do you decide which one is better, ETFs or individual dividend stocks? It really depends on your goals, experience, and how much time you want to spend managing your portfolio. If you're someone who loves researching companies, following financial news, and taking control of your investments, individual dividend stocks might be the better fit. You can tailor your portfolio to match your risk tolerance, income goals, and long-term strategy. You can even focus on dividend growth, choosing companies that might start with lower yields but increase payouts every year. On the other hand, if you prefer a simpler, hands-off approach, dividend ETFs are probably your best friend. They let you instantly diversify, lower your risk, and get consistent income without needing to analyze anything. You just set it, forget it, and collect your dividends every quarter. Many experienced investors actually combine both. For example, they might use a dividend ETF like SCHD as their core holding, providing steady income and diversification. Then, they add a few individual dividend stocks, maybe a few blue chips like Coca-Cola, Pepsi, or Johnson & Johnson, to boost yield and personalize their portfolio. That way, they get the best of both worlds, stability from ETFs and higher growth potential from individual stocks. It's also worth considering your investing stage. If you're just starting out or have limited capital, a dividend ETF can help you build a strong foundation quickly. As your portfolio grows and you gain confidence, you can start picking individual dividend stocks to increase your income potential. Another thing to look at is dividend growth versus yield. Some ETFs focus on high yield, meaning they pay more now, but may not grow much. Others focus on dividend growth, meaning you get smaller payments today, but they increase every year. Similarly, with individual stocks, you can decide whether you want high-yield companies or fast-growing dividend payers. Risk tolerance also plays a big role. Individual stocks can be volatile. One bad earnings report, and your stock could drop 20%. ETFs smooth out those ups and downs because of diversification. If you're the type who loses sleep over big price swings, ETFs will keep you more comfortable. Let's look at an example. Suppose you invest $10,000 in individual dividend stocks, 5 companies paying an average yield of 4%. You'd earn around $400 a year in dividends. But if one company cuts its dividend, your total income might drop to $320. Now, if you instead put that same $10,000 into a dividend ETF with a 3.5% yield, you'd earn $350 a year, slightly less, but more stable and predictable. Over the long run, that stability can make a huge difference. At the end of the day, dividend investing, whether through ETFs or individual stocks, is about creating reliable cash flow. It's about letting your money work for you, month after month, while you focus on living your life. The key is consistency, patience, and reinvesting your dividends whenever possible to let compounding do its magic. If you reinvest your dividends, over time you'll own more shares, which means more dividends, which buy even more shares. It's a snowball effect that can turn small investments into significant wealth over 10, 20, or 30 years. So what's the bottom line? Dividend ETFs offer simplicity, safety, and instant diversification, great for beginners or anyone who wants a passive approach. Individual dividend stocks offer control, customization, and the potential for higher returns, perfect for investors who love doing their own research. Both strategies can build wealth and generate cash flow, and the real secret is staying consistent no matter which path you choose. If you got value from this video, make sure to hit that like button and subscribe to Stock Predictor for more investing insights every week. Remember, it's not about timing the market, it's about time in the market. Start today, stay disciplined, and let your dividends build your financial freedom.